Good morning. I, Amit Kumar Arora, welcome you all in this lecture of capital structure. Today, we are going to discuss about capital structure, what are the factors affecting capital structure of an organization, what is optimum capital structure, and what are the various theories of capital structure. This is one of the most important concept in financial management. Capital structure, when we define capital structure means a structure of our capital. That means components of our capital. Suppose we are going to have 50 lakh rupees capital. So how we will raise the amount of 50 lakh rupees? How much will be the equity share capital in this 50 lakh rupees? How much we will take from preference share and how much will be the debt capital and why? This we will discuss in our capital structure. A company may raise its total capital from various sources, as we know, that can be equity share capital, preference share capital, debentures, and other long term borrowings. Capital structure gives the answer of the following questions: which of these above mentioned securities, that is, equity, preference, debentures, may be issued for raising capital? To what extent we can issue debentures? What should be the ratio between equity and debt? What should be the ratio among different securities? Next topic is determinants of capital structure. What are the factors which determine the capital structure of an organization? There can be difference in the capital structure of every organization. Someone can prefer equity share, some prefer preference share, and some prefer debt capital. So there are so many factors which affects the capital structure of any organization. Some of them are listed below. First is degree of control. Degree of control: if we want to have our control on the organization, we don't want to dilute the controlling power, so in that case, we should prefer to issue preference share or debentures. We should not opt for equity shares because as we know, equity share are the owner of the organization. Nature of the business: if the nature of the business is risky, in that case, we should prefer to issue equity share. As we know, equity share are the risk capital. There is no fixed permanent liability with the issue of equity share. There is no liability of payment of dividend and payment of capital also. Age of the company: if the company is new, in that case we should prefer to go with equity shares because new firm is having more risk as compared to the older firm. If the company is old, they maybe have sufficient funds, sufficient surplus, sufficient unappropriated profits, which can be utilized for the payment of interest and dividend. So, in that case, we can go for any of the component of capital. Next is period of financing. If the requirement is only for short term, so it will be preferred to take loans or issue debentures because they can be easily redeemable in near future. But we should not opt for equity because as we are aware that equity are non redeemables. Stability of the earning: if the earnings are not stable, there are very much variability in the earning. In that case, we should prefer to issue equity share in place of debts or debenture, because debts and preference share, because these are the fixed cost bearing securities. In these case, we have to pay minimum amount of interest and minimum amount of preference dividend. So if the earnings are not stable, so we will prefer to go with equity. If the earnings are stable, then in that case we can opt any of the option where we can go with equity, preference, and debentures. Next, size of the company. Size of the company: if the company is small, then they can utilized the amount from short-term sources or short-term borrowing and loans. If the size of the company is big, the requirement of the capital is also more. In that case, they can go with all the alternatives. Taxation policy also affect the amount of capital structure. In the case of high taxation, they prefer to issue debts, and there can be other reasons also. Now, moving to the next topic, what is optimal or balanced capital structure? Balanced capital structure means a combination of debt and equity where cost of capital should be minimum and return should be maximum. According to Solomon Ezra, optimum capital structure can be defined as a mix of debt and equity which will maximize the market value of a company and minimize the cost of capital. Objective of optimal capital structure: minimization of capital cost. Capital structure should be designed in this way: the cost of capital should be minimum. Minimization of risk, the risk associated should be minimum. Preservation of control, there should be no dilution of controlling. Maximization of return, every firm wants to have maximum return, so we should design our capital structure that can enhance the return of the organization. Now, moving to the characteristics of an optimal capital structure. An optimal capital structure should be simple capital structure. It should not be a complicated one. That should provide the higher return to the organization and to the investors. That should have minimum fixed cost burden. Safety of control, there should be no dilution of interest. That should be economic point of view. That should be economy attractive for all type of investor. There should be for equity, there should be a combination of equity preference and debts. Any type of investor which is interested in any of the security that can invest into that. Flexibility, there should be flexibility option also. As per the requirement, we can reduce or we can increase. A balanced leverage, optimal capital structure is that structure that should be balanced. Balanced means there should be a combination of debt and equity. Now, moving to the next important part, theory of the capital structures. There are four theories in this chapter. First is NI approach, that is net income approach. Second one is NOI, net operating income approach. Third one is traditional approach. Fourth one is Modigliani and Miller approach. Now, moving to the first approach, that is net income approach, which is given by the David Durant, which is also known as fixed key theory. According to this approach, a firm can minimize the overall cost of capital and increase the value of the share, value of the company by using debt financing to the maximum possible extent. That means it this theory supported to use more and more debts in your capital structure to increase the value of the firm and to decrease the overall cost of capital. The theory says that debt capital is cheaper as compared to the other sources of finance. So we should prefer to have more and more debt in our capital structure. Moving to the next theory, that is NOI theory. Under net operating income approach, this is again given by the David Durant. This was the just opposite of the NI approach. According to this approach, there is no optimum capital structure. All the structure are optimum. There can be any combination. A firm can use any combination that can be 60 equity and 40 debt, 80-20, 50-50, 75-25, or even 100-0 or 0-100. The, according to this approach, there will be no change in the value of the firm and the overall cost of capital will remain constant. Hence, there is no optimum capital structure. All the structure are optimum. Then moving to the traditional approach. Traditional approach is a combination of NI and NOI approach. Traditional approach is that in the beginning, when we increase the debt funds, overall cost of capital decrease up to a particular stage, up to a particular level. After that, decreasing trend of overall cost of capital stop and remain constant before going up, which can be called as the optimum capital structure, giving the minimum cost of capital. According to the traditional approach, initially when we use debt capital in our capital structure, the overall cost of capital will decrease as debt financing is cheaper as compared to the other. But what happen, it will increase to some extent only. If we go further beyond that extent, what will happen? The cost will start increasing in place of decreasing. For example, if we have taken debt financing and the debt rate is cheaper as compared to the other financing 2%, suppose we have taken 2%. Now debt is cheaper 2%. Now what will happen when we increase debt more and more and more? What will happen? The risk in the organization will increase and cost of equity will increase. At a time, what will happen? The cheaper benefit, what the benefit we are going to get 2% cheaper debt will be offset by the increase in the value of equity, and at that level there will be no profit and no loss. And after that, when we increase further debt, what will happen? The benefits of cheaper debt will set off, will completely off, and they will start giving negative return, and the cost will start increasing. Now moving to the fourth one, Modigliani and Miller approach. Modigliani and Miller approach, it divides its theory into the two parts. When corporate tax doesn't exist, when corporate tax exists. When corporate tax doesn't exist, the theory, theory is equals to the net operating income approach. In its conclusion, argue that in the absence of taxes, a firm market value and cost of capital remain unaffected to the change in capital structure, because if corporate tax does not exist, the cost of capital, use of debt on account of deductibility of interest charged from tax purpose, we are not going to get the benefit. And when corporate tax exists, if corporate tax exists, assumed to exist, hypothesis is similar to the net income approach. That is, value of the firm will increase and overall cost of capital will decrease with the use of debt, because the reason given by the Modigliani is because of account of deductibility of interest charges from tax purpose. So thank you very much. In this video, we have discussed about capital structure, what are the factors affecting capital structure, and then optimum capital structure, what are the characteristics of optimum capital structure, and various theories of capital structure. In the next video, we will discuss how to solve the numericals under the four capital structure theories. Thank you very much for joining, and if you want to get further notification of my new videos, kindly subscribe the channel. Thank you very much. Thanks a lot.